Good afternoon, everyone. Thank you so much for joining us today. We have assembled an outstanding panel today. Today is all about building your single family rental portfolio and how we are going to take you all the way through acquisition to managing that. We have put together the top minds in the space from across our country. So happy to have you here with us today. Grab a pen, grab some paper, take some notes. You as the investing community are going to learn how to build your portfolio in these super exciting times. So first, let's take a minute or two for each of our panelists to introduce themselves. Michael Finch, Principal Founder and EVP at SVN SFRhub. Michael, welcome aboard.
Thank you, Jeff, and thank you, everybody. Appreciate you all listening in, and looking forward to the discussion today. As Jeff said, my name's Michael Finch. I'm a principal founder of our SFRhub companies, which we have a commercial brokerage company focusing on single family and build for rent investment portfolios. We've got a data valuation and digital transaction site at SFRhub.com that powers our brokerage. We're involved in some modular or new home building sales systems for groups that are looking to use new building systems in the build for rent space. We can help source debt and equity through one of our investment banking capital partners, and obviously through RCN. We introduce a lot of groups looking for debt on our portfolios that we have listed, and we also run a capital fund called the SVN SFR Capital Fund that buys build for rent communities. But so we are kind of all things in the SFR and build for rent world, big believers, and looking forward to the discussion here.
Michael, thanks so much. As always, you have a lot going on. Love it. Next up in the life cycle of our loan is going to be Scott Saunders, SVP at Asset Preservation. Good to see you, Scott. Scott, unmute yourself.
Real excited. We're excited to be here, and I'm with Asset Preservation. We're a leading national qualified intermediary. We do 1031 exchanges nationwide, based in Roseville, California, with an office in New York. And we do all types of 1031 exchanges, so delayed exchanges, reverse exchanges, parking arrangements, build-to-suit improvements. And so we're going to be talking about that strategy and how people are using 1031 exchanges to build portfolios, single-family rental portfolios, and redeploy their equity into better performing assets. So really excited to be here with you today.
Yeah, I love it. Folks are going to get a ton of value out of that, especially with the appreciation we've seen across the U.S. Next up, we have Chris Doran, Head of Sales at RCN Capital. Chris, good to see you. Chris, unmute yourself.
Good point. Thank you, Jeff, for the introduction. At RCN, we do a lot of types of lending, but our primary focus today being on the portfolios. We'll be talking about the portfolio lending, how we finance those projects, how you can use leverage to improve and build out your portfolio, and what you need to know really going into the process as far as what's required to get the portfolio loan through, what you should be looking for as far as qualifications and requirements go, and really helping investors expand their portfolio business, have that passive income that they're looking for to, develop for, generational wealth, really.
Love it. Love it. Thanks so much, Chris. And next up, we have John Watt, Vice President over at Innovative Risk Solutions. John, good to see you again.
Great to see you, Jeff, and thanks so much for the invite. Our focus is preserving the assets of investors, and that is we're an insurance provider where we have programs of insurance that are designed for exactly the type of business that you all are doing, whether that's fix and flip, whether it's buy and hold, build to rent. We've got programs that are designed for exactly what you do. We hope to be able to demonstrate how you can get the best value for your insurance dollar, and make it so easy to use. Not only the administration of the program, but being able to get to that closing table with exactly what you need, so that makes for a real smooth transaction.
Love it. Really look forward to diving into the details. And finally, we have Randall Henderson, VP Residential and Commercial at Property Management, Inc. Randall, once again, great to see you.
Hey, you too, Jeff, and thanks everyone for having me on. Hey, I'm happy to back cleanup, as property management sometimes does, right? So I'm representing the PMI, or Property Management Inc. It's a franchising group. We're closing in on 300 locations. So our approach to the market is boots on the ground property management with the corporate oversight and accounting, just to do things right. We have a mixed portfolio currently that we're managing that totals about 65,000 properties right now. And been excited to partner with a couple of you guys on this call in the past, and just hoping to add a little bit of value about thinking, when should you involve that property management? How important is that piece as you go to look at some of the SFR and BFR portfolios? So thrilled to be here and excited to chat with you guys.
Thanks so much, Randall. And once again, my name is Jeffrey Tesh. I'm CEO of RCN Capital, and really great to get together really folks across the industry who know what they're doing. And we want to bring that value today to you. And once again, we're going to take you through the life cycle of acquiring that asset. And that starts right out of the gate with looking for the asset and using a partner such as SVN, SFRhub, and their amazing platform that they've put together. And Michael, let's get right into it. You know, clearly you have established something that's very different from other, we'll say, vendors in the industry. Maybe talk to the investing community today about how your platform elevates that experience for the customer.
Yeah, thank you, and happy to. And in large part, this platform is because of everybody here. You know, we as a commercial brokerage, as far as I know, are the only commercial brokerage 100% focused in this space. That's SVN, SFRhub Advisors, 6th largest commercial brand. We've got 200 plus offices around the country, so boots on the ground in 500 submarkets. But we're the only one that I'm aware of that's really 100% focused on working with buyers and sellers in this space. And because of SFRhub.com, that's our tech company, we're also the only ones that I'm aware of that are cleaning and verifying data. And before we're valuing the homes and putting, the operating expenses together, which is everything that an investor needs to make a good business decision. But what we've been able to do is assemble alliance members, such as everybody on this page here. So if you're an investor out there and you're new to the space, you can come on SFRhub.com. You can see all the portfolios that we have listed. Oftentimes we've got off-market deals as well, because we know what's out there. We know the pipeline that's coming in. So we can help source deals in different markets per your criteria. And then we can also get you introduced to all the necessary team members that you're going to need to buy a portfolio, whether it's property management, insurance, general contracting, debt, so everybody here is in our view part of the global team of SFRhub Advisors, which is a benefit to the clients. It's a lot of work, pulling together a portfolio, and there's 1,000 people that have been doing it for years and they've got their systems down, but there's thousands more coming into the space because of all the attention that it's gotten. And it's a true commercial real estate asset class now. So we can give kind of a soup to nuts platform with the alliance members that are here to any investor out there that wants to figure out how to acquire a portfolio.
So let's talk about that for a second, right?
Sure.
Many investors, whether they've been buying multifamily, retail, other asset classes, they may be new to this space, Michael. Maybe talk a little bit about not only the single family rental, but also the build to rent and the evolution and how this asset class has become so sophisticated that you've really built a company around.
Yeah, well, it's an asset class that's been here forever, right? It just hasn't gotten the Wall Street or commercial attention up until the last, call it 5 or 10 years, as some of the big groups like Invitation Homes and Progress Residential and Amherst have proven the space. But it's been going on forever. I mean, I remember my best friend, on my block when I was 5, his dad owned 7 homes in the neighborhood. That was 1983. So, this has been a long time coming, and for the retail and the multifamily guys, that have always said, oh, well, it's hard to operate these scattered home portfolios. That's all been proven to the contrary. It is, whether you're going to talk to Randall, or another local PM, they've got their efficiencies down on managing these properties. So putting a portfolio together of homes that operates, in many cases at a higher NOI margin than multifamily, that comes as a shock to a lot of people, but it's true. These can operate very efficiently. I think it's an exciting time for investors looking at the existing single family portfolio market, because it has now been proven over and over again that it is a risk mitigated, stable, long-term wealth growth strategy, for your money. And the build for rent market, which, we have been extremely bullish on and been leading the industry in a number of ways, from, consulting with builders and developers and buyers on just how build for rent works. But again, not a new strategy. Build for rent was very popular pre-1970s, and it just went a different direction. But here we are 50 years later. Like everything, it's cyclical, it's coming back, and it's absolutely needed. The build for rent marketplace, with the lack of supply, is making home builders both happy in a for sale and for rent market, because it wins in either case. And the good thing about build for rent is that you have longer term tenants, you've got more affluent tenants. If there is any type of a market correction, it's the first time the builders now have an opportunity to keep their subs busy and keep building and selling homes to investors instead of the home, the retail consumers. And if you're losing a home to foreclosure, you're likely not moving into a 1-bedroom apartment. You're going to want to rent a 3 or 4 bedroom home in that market that you're living in. So the build for rent marketplace has legs in our eyes for 10, 20 years. It just looks very attractive.
Yeah, I think that's really well said. We're certainly seeing that across the United States. It's amazing the number of folks that, as investors, maybe we're doing short-term bridge loans, and what they're realizing is building out their portfolio gives them not only their individual income, but it can be truly generational wealth that they're building. So I'm an investor, I own properties, I'm interested in taking that next step. How do I get started with you? What should I do?
One, just pick up the phone, give me a call. I'll get you introduced to the right team members. We'll talk about the markets that you'd like to be in, the type of returns you're looking for, the capital that you have at your disposal today, your growth, help you with that growth strategy. What are you looking to accomplish? To your point, Jeff, this is a long-term growth strategy play. You can always look at it in the short term as well, depending on the time you're buying homes in a cycle. But I think the best and most encouraging part of investing in single family homes is that it's proven itself. If you go back 30 years, it's been more stable and more profitable than every single commercial real estate asset class over time. And that includes stocks, bonds, and annuities. Now, it hasn't faced some of the high highs that maybe multifamily and healthcare have, but it's never faced the low lows either. So it's been a very strong and steady growth rate over time, and that's something that should be of high value to every investor, whether they're in office, retail, industrial, multifamily, and trying to figure out where to put their money and keep it safe. And I'd say single family rents all day long.
Yeah, absolutely. So the next step for us in this process is going to be thinking about folks that already own properties and are maybe selling assets, and thinking about how they raise cash to be able to do that transaction. And Scott, your company is certainly an expert in the 1031 exchange. maybe talk to us about why the 1031 exchange makes so much when they're dipping their toe into this asset class. Talk to us about that, Scott.
You bet. 1031 is such a powerful strategy because it allows you to take all of that equity, all that gain, and redeploy it into more assets. So Michael mentioned somebody that had 7 houses in his neighborhood. You see people start off with 1, 2, 3, 4 single families, and then they'll exchange that for 4, or from 4 to 8, and maybe they'll go from 8 into 12 and 16. So the 1031 exchange, it's been in the tax code since 1921, so almost 100 years next year. Been around for a long time, and it really allows an investor to go from any asset class, but we're seeing a tremendous amount of demand for single family rental portfolios right now. We're seeing people wanting to get into that as an asset class. So you take all of that equity, and instead of paying taxes, right, you've got up to 4 levels of taxes you would pay if you do it in a taxable sale. You pay capital gains, depreciation recapture at 25%, net investment income, what it applies to 3.8, and then state taxes. If you're in California, you've got state taxes of 13.3%. So add all those up, and that's a big tax hit. So instead, you do a 1031 exchange, and you can roll that in, and a lot of times leverage up, right? Bring some financing with some of the people on this call here, this webinar, and leverage up and get a lot better return on investment. So it's a great tool. In fact, that's how a lot of people build portfolios, is they redeploy over and over again and then boost their rate of return. And then they also take advantage of maybe moving geographically. Maybe somebody starts off with a few assets out west where there's been a lot of appreciation, and they roll that into maybe a Midwest market where they're going to get a lot more cash flow out of those assets. So just a really, really powerful strategy.
And we certainly see that at RCN Capital all the time, which is folks trying to leverage ways to keep that money invested at all times and not give it back because of those tax issues. So once again, let's put our customer foot on, right? So I've gone to SFN, SFRhub. I have identified a portfolio of properties that I want from them. In other words, I'm going to transact with them, but right now I've got some other assets that I'm under contract with, I'm selling. So walk our customers through today how they should approach this and how they can use your services.
Great, thanks. First of all, with a 1031 exchange, you need to get the 1031 exchange set up prior to closing on the assets that you have under contract. And unfortunately, you believe it or not, we see investors every month that sell assets and after the fact go, oh, I should have set up a 1031. So step number 1 is once you've got those properties under contract, contact what is called a qualified intermediary. That's what we do. We're the ones who prepare the paperwork and we hold the funds. We actually structure the 1031 exchange. Now, when the property closes, you're going to have some certain time deadlines. And what I recommend, and I'm sure Michael might agree with this, is once your property's under contract, start looking for those replacement properties, right? That portfolio. Don't wait until you close. I think that's where people right now, because the market's very, very robust, right? We're seeing properties turn over very quickly. There's a lot of demand. Start looking, so contact somebody like SFN once you're under contract, and you can actually make an offer and get that set up. So when you close, you've got 45 days to identify. But I'd recommend get that property lined up in advance. That way you can maybe take the extra time, maybe need some time to close on the portfolio, but you've got a 45-day period to identify and a maximum of 6 months to close on what you've identified. Get that done. And normally we're seeing people today, instead of taking months and months to close, they're closing in a matter of 3, 4, 5 weeks on that replacement portfolio. So you've got the time there if you need it, but practically speaking, line up those replacement assets. That's the biggest challenge. And that's why, you know, using somebody like the SFRhub Advisors, you can look for some assets online and start figuring those out right away. It's very helpful to do that.
Yeah, I appreciate saying that, and sorry to cut you off there, Jeff. But I do appreciate you mentioning that, Scott. And yeah, I mean, if you're going to be selling something, log into SFRhub.com, start searching around, talking to us. We can help, direct you on where we may have some other deals coming, based on your timing. So yeah, it's always best to get ahead of the game. We've always called that, you close on that 1031, you have a gun to your head. Nobody wants to make those quick decisions. So, it's better to get out ahead of it.
No, and I'm glad you jumped in there, Michael, because the follow-up question I had for you, Scott, is once I have gone under contract, talk to our audience about the timelines. What do they need to understand before that 1031 expires?
Yeah, well, the timelines from when when the property that you're selling, what we call the relinquished property, when it closes, that's day 0. And you have 45 calendar days. And they're going to go through weekends, they'll go through holidays. And on the midnight of the 45th day, you have to identify assets that you want to buy. So that's really the critical time period. After that, you have another 135 days to close on what you've identified. So it's a maximum of 180 days. There are different ways to identify properties. So there's one called the 3 property rule. So I sell one asset, let's say for $500,000, and I can identify 3 replacement properties of any value. When we're looking at maybe doing a portfolio, we might be using the 200% rule. So under the 200% rule, you can identify multiple assets, right? You're not limited to 3, but you can't go over twice what you sold. So if I sell for, let's say, $1 million, I could identify a bunch of $100,000 homes, but they can't go over $2 million in aggregate value. And generally, you're going to use one of those 2 rules. There's one last rule that's rarely used called the 95% rule, but generally either the 3 property or the 200% rule you'll use to identify. You identify the property, and then the intermediary is going to step into the shoes through an assignment of the contract and buy the portfolio, right? Use your money that's being held by the qualified intermediary to purchase the portfolio, and then that's deeded back to you to complete the exchange.
Boy, I tell you what, it seems like having that knowledge going into this process is everything, because the amount of tax dollars you must be able to save, especially depending on what geography you live in, it's just got to be tremendous.
Absolutely, absolutely. That's why people take advantage of it. Why, when you're going to go back into more real estate, would you ever pay all the taxes when you can do what, and it's tax deferral. So, right, you're kicking the can down the road, but it gives you a chance to use all of that gross equity to go ahead and redeploy and purchase more property versus if you did a taxable sale, you'd only have the net equity after taxes to redeploy. So this is how people build portfolios. The 1031 exchange is probably the key strategy to really building a large portfolio over time.
That's very well said. Great information for the folks. Also, I'd like to remind our audience today, we will be taking questions at the end. So please go into the bar at the top of your screen. Feel free to put in any questions during this webinar, and we're going to leave a few minutes at the end for our experts to be able to answer those. So moving on to Chris. Certainly, we've identified the properties. We've considered 1031 exchanges. From a financing perspective on portfolio assets, what are you seeing in the marketplace today, and how are customers being able to use leverage instead of cash to really help build their portfolios, Chris?
Yeah, we're really seeing that in 2 different ways. First, if you have somebody who's making a purchase of a portfolio and you're taking Scott's advice there and you're using that 1031 exchange to increase your buying power because you'll have more of your gross return rather than the net return. So you'll have more down payment money available to you. That might be the difference between you picking up a 5 property portfolio and a 7 property portfolio or something in maybe a little bit better market that you're looking for. So taking advantage of those tools really gives you more, bandwidth and possibility within your own flexibility to choose your options as far as moving forward. And for us as RCN, as a lender, what we do is we can finance the purchase of a portfolio of properties for you. Purchases go up to 80% of the purchase price. So If you have your 20% down from your 1031 exchange, or if you've really done well, maybe you might even have more than 20% down, which if you reduce the amount of the leverage on the loan, if you choose to do that, you'd actually even get better pricing there. But we offer anywhere from a 30-year fixed rate mortgage on these portfolios. We can do 3, 5, 7, 10-1 ARMs on these portfolios. You can even do a 5 or 10-year interest-only option if you're really looking to maximize the cash flow of those properties and take more in as the investor. So we give you a lot of flexibility and pricing options within the model itself. One of the other ways that investors will look to leverage a portfolio would be to take existing rental properties that they have. Maybe you have them out on a handful of different bridge loans. Maybe you did a purchase and rehab on some of those, and now you're looking to, bundle those up. They're all stabilized now. We can cash those out for you up to 75% loan to value. You can then take the cash out proceeds and use those as leverage to, buy new properties as a down payment, or buy new stuff all cash, depending on what type of investor you are. Some investors still like to purchase the property and get that sweat equity in there with some rehab dollars. We can help you with that as well, and then do a refi after the fact. But if you're able to buy, the portfolio of properties like SFRhub offers that are, really prime and ready to go as rentals, if you can establish that kind of a purchase and get the financing for it up front on the purchase side at max leverage, you only have to deal with one closing. You're only paying one set of closing costs. And that's the real advantage to be able to do the portfolio as a purchase option. And if you're taking, the good offers that are available on the SFRhub site, if you're using the, financial tools available to you through the 1031 exchange laws, and you got a good lender who can provide the leverage and financing support for you, you can really maximize the bang for your buck in everything you're investing in here. And that's really critical for investors. If you're leaving money on the table or opportunity on the table, that does, slow your investment profile over the years.
Interesting. So my guess is today in our audience, we've got a wide variety. We have probably seasoned investors. We probably have middle of the road investors. We probably have novice investors. Some investors maybe have been acquiring single assets and are starting to build a nice portfolio. Others are more seasoned in portfolios. Maybe, Chris, you could talk for a minute about the difference between a single asset underwrite and sort of aggregation from a lender perspective versus a portfolio. Maybe walk the potential customer through on the difference and how they can expect that interaction.
Sure. So with the single asset kind of loans that we do for your rental properties, that process is a little bit quicker just because we only have one asset to really analyze and make sure that it's going to meet all the different guidelines that we're going to have on those. When you're talking portfolios or groups of properties, that's when you get some. It takes a little bit longer sometimes depending on how many properties you're doing. Any portfolio loan for us is going to be a minimum of 3 properties, but it could be 3, it could be 10, 20, 30, 40, it goes up from there. And so depending on how many properties we have to analyze will affect the timeline of the loan a little bit. But you do get advantages from using a portfolio rather than just doing a single asset. So within a portfolio, we'll give you a little bit more flexibility about the actual appraised value that you need to be hitting on these things versus if it's a single asset. So we'll have a little bit more flexibility there because other assets within that portfolio can help compensate for maybe some of the weaker properties that maybe don't have as good a value, or maybe the cash flow isn't quite as strong on those. So if we have other properties within the portfolio that do support it with a higher cash flow, we can offset some of the limited cash flow on 1 or 2 of those that you might be putting together to really help enhance the portfolio and maximize your leverage and your qualifications for those deals. It's nothing worse than if you only have a single asset property, and if it's got a low value to it, you don't have other properties to kind of support it and get it qualified. That can be difficult to do on a single asset loan. Whereas if it's 1 of 10 properties and the 10 properties are 9 out of the 10 are more stable as far as value goes or cash flow goes, that can help offset the concerns that a lender is going to have about the one asset that might be a little weaker on cash flow or value given a particular market. For these types of loans, a couple of things that you'd really want to know going up front would be, if you can provide us with a spreadsheet that'll have the cash flow data we're looking for on these properties. So that would be, your taxes, your insurance, if there's any HOA dues, if you're in a flood zone, and then what the rents are. If they're not rented currently, what do you think the market rent would be for that property? But occupancy can also play a big factor in these. Occupancy on a purchase portfolio is a lot more flexible than occupancy if you're trying to do a refi or cash out. Generally, for lenders on a refi and cash out, we want to see that the occupancy is a little bit higher, whereas when a purchase, it's more understandable that you would have vacant units, so that's a little easier to get by there. So those are a couple of things up front that can really make a big difference when we're starting to analyze these portfolios of properties, and making sure that each property within it is going to meet our minimum guidelines there. And if there's any kind of borderline properties, seeing if we can compensate by using some of the other assets in there that maybe are superior in quality.
And that's really what very well said, Chris. And, one of the reasons as a lender, we love customers coming through SVN SFRhub is all of the data that comes along with that customer when they're purchasing properties through the SVN SFRhub. And Mike, let me just throw it back to you a sec and maybe talk for a second about some of those requirements that Chris was just talking about that your company certainly drills down on the data for.
Yeah, and I appreciate that. We take a lot of pride in cleaning and verifying the data that comes into SFRhub. So we go through about 25, 35 checkpoints on each individual home. So we're gathering, from bed bath counts to making sure that, if there was a fourth bed that's a garage, there was actually a permit, pulled on that. So it's truly a 4-bed and not legally a 3. I mean, these things really affect the values. But for a group like, RCN, if we can deliver, we clean and verify the data, we put the values together, or some might call them BPOs, but we're very, very good at what we do and very accurate. So we're giving confidence to the lenders that we're working with, but we're also putting together the income approach. We'll have all the tax information, the HOA information, the insurance information. We're getting third-party insurance quotes, on that portfolio as well, along with the seller's actual insurance. So, we're putting the entire current pro forma, or I should say the current operating expenses together based on where the seller is today, and then where the investor can be tomorrow, as well as school ratings, and a few different other market metrics that really help paint a broader picture of what's happening with the portfolio, which is extremely important, obviously, to you guys at RCN to properly underwrite it.
Yeah, and folks, in the audience today, I can't stress enough, as a lender, we love to see complete files. And when the potential customer comes through an organization like SVN SFRhub, instead of just a retail licensed real estate agent, it comes with a package of data that speeds the process along of our underwriting. Oftentimes customers wonder, well, why does it take so long to underwrite a loan? Well, if we're constantly asking for this and that, and it's all coming in piecemeal, it's so much easier to have all that data provided to us up front, and we can give quick answers. Mike, appreciate the input on that.
Yeah, and if I could just add to that, I mean, we've applied institutional investing, sort of thesis to these portfolios because all of our background was in commercial real estate investments. So unlike a realtor who's probably very good at selling a vacant home, it's a different animal to put those numbers together and understand, what you're looking at in underwriting, and that's been our background, years before we were in the SFR industry.
Yeah, we love it as a lender for your customers. And you mentioned insurance, so a perfect segue over to John. At the end of the day, John, we need to protect these assets, and as a lender, we certainly require that our customers protect these assets. So talk to us today about how your services are being used by not only small investors, but more institutional investors in protecting these assets. Take it away, John.
Well, thank you, Jeff, and thank you, Michael, for the valuable information. As soon as you found the perfect portfolio of properties for you through SVN, of course, you need to protect those assets for a variety of different things. The first one, of course, is property damage in the event that you have a fire, you have a windstorm, flood, whatever perils your property might be at risk for. And then there's also liability exposure, that if somebody slips and falls on the property, you don't want a new partner on your new project. You need to have somebody that can defend your interests and let you move on. Protecting your assets, I say it starts with hiring a trusted advisor, just the same way that you're doing with your lender, with your realtor, everybody that's in the group of advising you all the way through the process. And a trusted advisor is someone who knows your business and has the products to be able to satisfy those needs. Jeff, are we hitting the mark there?
No, it's exactly right. Because at the end of the day, the customer needs to understand that they're protected. Maybe walk us through how you interact with someone who is getting ready to execute on a purchase with SVN, and how that customer interacts with you. Just kind of walk us through the process, John.
Well, generally speaking, we have folks that approach us. Hey, I'd like a quote of insurance on my property. And sure, that's easy enough to do. You send us the property information, and particularly when it comes through with SVN and has as much detail as it does, then that really can accelerate the process. The more detail that we have, not only on the individual properties, but with what the requirements are from lenders and so forth, allow us to hit the mark early on. So give us a list of properties, tell us a little bit about you, what your plans are. Are you planning on renovating and fixing and flipping? Are you planning on holding for rental? What's your plan and on what you want to do? And then also your thoughts on investing as well. Do you want to take a little bit more risk and have a higher deductible? Do you need to go with maximum capital preservation so that we're going with lower deductibles? Again, if you'll be candid with us and let us know what your goals are and so forth, we can custom tailor a program very quickly for you that'll satisfy needs. And again, Jeff, coming to us, just give us an idea of what you're looking for. We can get through all the details and give you first some education on typically what's needed, and be able to hit all the marks to make sure that we've got a program that really works well for you.
So as an investor, right, I come to you, and my guess is there's different options for rates of exposure, pricing. Maybe talk the investor through what the best case scenario is on deductibles, and how they should think about this, especially as they're building a larger portfolio.
Well, as portfolios get larger, we see the use of higher deductibles because it reduces the cost of insurance, and it also reduces the incidence of claim activity on those portfolios, which is the key to keeping long-term insurance rates low. If you develop a track record of low or no losses over a period of time, you're certainly a very preferred account, and that's something that's very attractive to the insurance companies. So thinking of it as more of disaster coverage rather than, if you have a $1,000 or a $2,500 event, getting the insurance to respond is, you can do that, but it's going to drive your rates. If you use it more as disaster preparedness, then that's going to keep your rates low and keep them competitive. The sweet spot, generally speaking, on deductibles, years ago we used to see deductibles as low as $250 or $500. Realistically, the sweet spot on most portfolios is probably in the $5,000 area. the difference between a $2,500 and a $5,000 deductible on even a portfolio as small as 5 properties, you're actually prepaying losses for the difference between the two deductibles before you even have an insurance event. When we see the larger portfolios, we get into a $10,000 or a $25,000 deductible, or for the really big portfolios, we have some really interesting programs that we can do some cost sharing on that drives the insurance cost to really a minimal number.
Yeah, and that was going to be my follow-up question is as investors build their portfolios, maybe a few tips about how they keep their rates low, aside from the obvious. Higher deductibles usually mean lower rates, but are there any other tips you could share with us on how investors are keeping their rates low?
Well, the number one driver of rate is going to be claims. So that means that best practices property management is really what's going to keep your rates in line with with market conditions, and that is having a safe environment, taking care of maintenance when it needs to be taken care of. So most fire and water damage events are preventable with minimal maintenance. If we have a water that's having a little drip 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 going on, it's a huge difference from when a pipe bursts and now we have a real event. And if maintenance can be kept up, best practices, periodic inspections just to make sure everything's okay. If it's a handrail on the front steps into a property, if it's a sidewalk that's raised slightly that's exposed to a trip and fall, if there's a maintenance issue that hasn't been taken care of, like a roof leak. A roof leak's relatively easy to take care of. When that roof leak turns into something that brings the ceiling down on top of somebody's head, now it's a liability lawsuit. It's bigger property damage, everything else. So again, just to restate, best practices, good maintenance, good common sense will keep your insurance rates low.
Well, I got to thank you for the segue here to my friend Randall. We have taken our audience today from acquisition to 1031, financing, insuring the property, and now we need to manage that property. And as we have more and more sophisticated investors building out portfolios, it is time to get serious about management of those portfolios. Randall, when does that investor need to think about self-manage, moving on to something more sophisticated? Maybe walk our audience through today on how they need to think through that.
Yeah, well, let me just segue from John real quick too. There's been innovation on the insurance side that is helping to protect that class a little bit more. For example, PMI requires a tenant liability insurance to be in place on every property that we manage, where the first $100,000 of damage done by a tenant in a leaky pipe situation or a fire or an explosion is covered. And that's just a set policy that's in place across all of our portfolio. But Jeff, to back up, SFRhub, Michael, what you guys are doing, you are certainly ahead of the game, but the game has now caught up in many ways. It's been a very attractive space. And as that's happened, Jeffrey, to your point, the property management side of things has felt significant pressure to improve, increase, become not just an afterthought of, hey, let me now find a manager. I've made this investment, because as an investor is working up a budget on that property, typically the property management is just a line item expense. And when you can change that, and when you can find a property manager who is actually an asset to you in your due diligence period, they can help you understand and analyze the expenses on a property. It matters so much more in a single family portfolio than it typically might in a multifamily. And that's because, generally speaking, multifamily management companies are extremely different than a single family management company. So when you're looking at a portfolio in SFR or BFR, you need to find someone who's good at that SFR game. because it's going to be a different skill set. You can't just go to a multifamily manager and expect that person to be an asset on the single family side. The software is different. The approach to management is different. Having 100 or more discrete properties that may be spread over a 100-mile radius, it presents a completely different challenge than most multifamily management companies are handling. Having said that, if you can incorporate that property manager very early in the process, I would say make them a part of your dream team so that they're able to look at the investments with you, even as you're before you're putting things under contract, to help you look at them and see what's happening there, what's not happening there. One thing we do know is that the rental statistics are extremely strong in this country right now. Jeff, you mentioned that there's a very large portion of self-managed investors. When does that change? It is changing right now, guys. 70%, that number is starting to shrink as we see more and more a different type of investor who is looking at investment into the single family. And you guys have mentioned it on this call a couple of times. It's people who saw their parents own 1 or 2 properties. It's people who have this mindset that you need to own real estate in order to make a dent in the wealth game. And as those people, even millennials nowadays, are starting to invest in an investment mentality prior to their own residence. So we are managing properties, guys. This will blow your mind. We're managing properties for people who rent themselves and they own investments. And so that shift and that thinking, that type of investor, they need a good asset manager. They need someone who's not just the guy in the wife beater who's plunging toilets, right? They need somebody who's going to think about the investment as a class and help them to analyze investments proactively. That's actually pretty hard to find in single family management. I think that's been one of the advantages with PMI is that we've tried, like Michael and SVN at SFRhub, we've tried to be ahead of the game and anticipate the pressure that's coming from this new type of investor and adjust our technology, our reports, our approach to the market so that we can service that new client. That means better tech, better reporting, just a different level of asset management, which you guys, I keep using that word. It's property management, right? But when we shift the mentality for the manager, it's asset management. So anyway, that's kind of my soapbox about where we're at. This new generation of investors, they need a new type of property manager, and we're seeing that change right now. So I hope that kind of addresses your initial statement, Jeff.
Well, no, it does. And, Chris, you could even opine on this, is one of the requirements that we have for portfolio loans is we ask about asset management and how that's been handled, not only going forward, but in the past. I mean, Chris, you could probably jump in on that.
Yeah, for us as a lender, we want to make sure that the investor either is, capable on their own of managing whatever number of properties that they have. Are they local to those properties? Or if they're, not in the same market, we're going to look to see that they do have property management in place to be able to handle those properties and any issues that might arise there. Or even if you just generally have a large number of properties, you really want to have a professional at your side who can keep on track of that stuff. Because for you as an investor, your focus should really be on how do I, acquire more properties? How do I acquire the right properties? How do I, get myself through this process without having to do the day-to-day operations of managing a large portfolio of properties? The more properties you get, the more headaches you're going to have with it, right? And if you can shift some of that kind of headache situation onto, qualified professionals like Randall's group, then you're really going to have yourself the ability to expand and grow your portfolio beyond what you just have. If you're dealing with the day-to-day of leaky sink, the light bulb's out, I don't like the way the shade hits the floor in this room, or whatever people are going to come up with as tenants. We've heard a lot of weird things over the years. If you're going to be bogged down with that stuff, you're going to have a much harder time growing that portfolio out. And, putting professionals on your team to really enhance your skill set and make you more than just one person or a couple of people who are investing together, you can really maximize efficiency here and grow it and take it to the next level. And that's what all this is about, right? It's about having all these different partners that we have on the panel here today who can leverage your, cash, your assets as an investor and your qualifications, and take all that stuff and bring it to the next level. How do we make it bigger, better, and less hands-on for you at certain parts of the process? Because if you're doing it by yourself, you have to be the expert in every one of these fields for yourself. If you have a good setup of your team where you have professionals that you can rely on who know what they're talking about specifically, then it's not something you have to be the expert on. I can be the expert on going and getting more assets from SFRhub and working on these deals and getting them closed. And, you know, my insurance and my property management can be handled by real professionals instead of having to worry about this stuff on my own and trying to, you know, get pricing from different vendors and things like that.
So Chris, to speak to that, oh, sorry, Jeff.
No, go ahead, Randall.
I'll just say one thing. A commercial manager, a classic commercial management company is not going to want to deal with this type of portfolio. They're not able to deal. Property management matters a lot more when people sleep there, and especially in a discrete, when it's single family. Like we recently worked on an opportunity. We opened a new office on the border of Michigan and Indiana. And one of their first calls, just open a couple of weeks, was an investor who is looking at buying a multifamily mixed type of portfolio. So PMI, we positioned ourselves as, hey, let us help you look at that deal right now before you're even applying for lending. Let us help you run the numbers on the budget. We were able to find significantly more operational best practices to create a lot more return, even prior to applying for that loan. The property is now under contract and we're set up for management. So that scenario works very well when you can involve the property manager early, let them look at that portfolio with you, but you got to find somebody who's boots on the ground because Chris, to your point, leaky faucet, you know, a sink, you're going to have a hell of a time trying to manage that from a centralized location. And that's one of the challenges as you look, you got to go where the deals are. Investors are going to go where the deals are. And so to try to find a property management company in each market is a pretty challenging thing. I think that's why PMI has been able to do well, is that we've got this model that is spread across. We're adding about 6 or 7 offices each month. And so we're looking to try to address this new problem of, hey, how do we manage single family portfolios all across the country?
And I just want to add something there because I think it's important, and you guys are dancing around and touching it, but you know, historically and specifically in residential investing, people have, you know, always kind of done the 7 to 10 miles of where they live. But because, you know, now you've got Randall and PMI, you know, with, you know, consolidated reporting and technology, you know, you can, as an investor, if you're in Seattle or LA or New York, and you know, you're running your 1031 through Scott, and you can buy 10 homes, you can buy in a high yield market, and you can trust that you've got, you know, the right team in place to manage those assets for you, so you don't have to worry about it as much. But you're gonna maximize your return, and that's, you know, something that, you know, through the advent of all the single family property managers, and especially the good ones like PMI that have been coming to market, that do this all over the country, you know, it gives you as an investor the opportunity to really target where, you know, you can maximize your yields and not have to worry about just having it in your backyard, so to speak.
Right. Randall, I just want to finish up with this last question for you, which is, I'm an investor, I've been investing myself. How do I think about getting you involved? Is it 2 properties, 8 properties? What is that bellwether number, or is there no bellwether number?
Nowadays, Jeff, I would say that if a property manager is not adding value to you, then move on. But there is no reason why, even with 1 or 2 properties, you shouldn't be looking for a partner who can add value. Guys, the services and the technology that Michael you know, talked about a little bit, that is now creating longer term tenants, more satisfied tenants, more wealth for the owners. So again, you got to shift your thinking, and it is a challenge because historically this hasn't been the case, to where property management is not just a line item. It's not an expense, it's an opportunity. So I would say absolutely involve a property manager as early as possible. Now, what are you looking for? Great. If it's PMI, fantastic. We'd love to have you. But if it's not PMI, what do you need to look for in a property manager? You need to look for technology. You need to look for communication. You need to look for somebody who aligns their goals with yours and who is actually adding value to you. Don't get stuck in contracts and management contracts that are a year minimum. try to negotiate out of that so that you have a period of time where you can evaluate that relationship to make sure that it is properly working. But again, a good property manager in single family space today has maybe 10 or 15 additional types of services that they're offering to a tenant and to an owner. Credit reporting, different insurance services. The list goes on as far as types of services that can be added that create more value, keep a tenant long-term, make the renewal process easier, and make you money as an investor. Find that type of property manager, and that becomes your dream team member rather than just that line item.
So I want to leave just a couple of minutes here, and the hour flew by as I knew it would, for a couple of questions. Michael, first we're going to go to you. Let's see. Steve is asking, what geographies make sense today across the United States? So I guess this is an investor who maybe is looking for a new home to start investing. Maybe talk about what you're seeing across the platform.
Yeah, I mean, there's a ton of good markets right now. I mean, you know, I'm headquartered here in Phoenix. We've seen rents rise and continue to rise. I've been leading the country in rental increases. I'm a big fan of Charlotte and the Raleigh-Durham markets. Atlanta continues to hold strong. You know, still relatively lower property values and taxes and insurance there, so you can get some of those costs down a little bit with still, you know, growing job bases and increase in rents. Secondary markets like the Savannahs of the world, or I've been a big fan of the Northwest Arkansas market. I mean, we see returns there, and people aren't looking, but returns there are phenomenal. So some of the good Midwest markets, Des Moines is a good one. You know, so you know, you can do this successfully in just about any market. You know, obviously it gets a little harder on the coastlines, specifically the West Coast, but you know, there's opportunities everywhere. So it really just, you know, as I said, you know, if we're talking to you and we can get a better idea of, you know, the quality of assets that you're looking for, the quality of tenants, and then the return metrics, you know, we can start, you know, finding the right markets to point you in that direction.
Yeah, no, that's well said. At RCN, we've been seeing a ton of aggregation in the Midwest, specifically Ohio. Columbus, Ohio is absolutely on fire right now.
Yeah.
It's amazing. Kansas City, Indianapolis.
Yep.
These are marketplaces where you can buy relatively new properties that give a great return on equity. Absolutely.
I'm from the Midwest. I mean, I grew up in a rental home. My friends, you know, I mean, people rent in some of these markets their entire life. So you know, I'm a huge fan of the Midwest for that reason, because it is a strong rental market.
We have another question that came in. How much money should I have to get started? Can that money come from a partnership, family, friends, family members? So looks like we have a relatively new investor here, Chris, who's, you know, asking how do they get started and where can the money come from?
Sure. So as far as getting started, we do work with experienced investors, but we will also do first-time investors. So experience is not necessarily a prerequisite for getting a loan for such a situation. As far as down payment resources go, best case scenario on a purchase would be to have the borrower put down 20% of the purchase price. You'll also have to cover closing costs, which will include setting up escrows for taxes and insurance, which will be paid out of your monthly payment. So we want to make sure that we have sufficient reserves there to cover those costs as well. It's really going to be specific to the scenario as far as exactly what the dollar figure is. But if you guys can get us as investors, if you can get that over to us on a preliminary basis, we can run the scenario for you. We can let you know exactly what the loan product will look like based on the information provided. We'll give you an idea, you know, here's what the rate's going to be, here's what your, you know, estimated closing costs will be, all that kind of stuff. But also let you know exactly, you know, based on these numbers, here's the amount of cash you're going to need to show in the bank. Here's the amount of cash that you're actually going to need to bring to closing. Because it's not just bringing the minimum down payment to the closing. We want to, like I said, make sure you have the necessary funds for closing costs, setting up your escrows, but also having reserves as a backup to make sure that, you know, when the day you close on this loan, you're not, you know, otherwise financially illiquid, right? we want to make sure you have liquid reserves in place so that you can, weather any kind of storm, whether it be, a tenant leaving or, in the current market conditions with COVID, maybe somebody losing a job or having an extended illness that might affect their income. So making sure that you have, good kind of reserves in place to kind of weather any of those kind of incidental storms that might come up. As far as being able to use funds from other sources, we don't allow you to borrow the funds from another lender, but what you can do is if you have, friends or family members who might be looking to chip in and help provide additional funds there, we can look to include them as like a minority member of the borrowing entity so that we can use any of those assets towards down payment, closing costs, things like that. So there's a number of ways to get creative with it. It's a good idea to consult with your loan officer. Remember, your loan officer is going to be a member of your team here too. We're not just on the lookout to, push things to the next level. We want to make sure we're reviewing those things on our end to make sure that you as the investor didn't overlook something in your analysis as well. And part of that's going to be aided by, the types of data that you're going to get from a place like SFRhub, where they're going to give you really detailed information about the property itself. But you want to have all that information kind of ready to go, so up front what you're looking at, right? You don't want there to be any surprises on the back end based on what you assumed up front might have been incorrect. So having that good information up front, really starting and doing the work on the front end is what's going to make this successful all the way through the process.
Well, I appreciate those answers, and I appreciate all the members of the panel today. We are at the top of the hour. Folks, if you still have extra questions, keep sending them in. We will distribute them amongst the panelists, and we will get back to you individually via that chat. But a big thank you to Michael, Scott, Chris, John, and Randall. The content today was really outstanding. One of the best webinars I have had the pleasure of moderating this year. A ton of content for our audience. Thank you so much. And we look forward to seeing everybody again real soon. Thanks so much. Have a great day.
Have a great day, everybody.
Thanks, everyone.
Bye.
Bye-bye.